Welcome. Today, we're diving into the world of investment vehicles. Whether you're a beginner or looking to diversify your portfolio, understanding the different ways to invest your money is essential. Investment vehicles are simply the products or methods you use to grow your wealth. From stocks and bonds to real estate and mutual funds, each vehicle offers unique benefits and risks. In this video, we'll break down the most popular options, explain how they work, and help you decide which might fit your financial goals. Let's start by understanding what makes an investment vehicle and why choosing the right one matters for your future. Investment vehicle is any method or product that allows you to invest your money with the aim of earning a return. Think of it as a tool or container for your funds. Some vehicles are simple, like savings accounts, while others, like stocks or real estate, can be more complex. The right vehicle depends on your risk tolerance, investment horizon, and financial goals. By understanding the basics, you'll be better equipped to make smart decisions and build a portfolio that works for you. Stocks are one of the most well-known investment vehicles. When you buy a stock, you're purchasing a share of ownership in a company. Stocks can offer high returns, but they also come with higher risks due to market fluctuations. Investors often choose stocks for their growth potential, especially over the long term. However, it's important to research companies and industries before investing, as not all stocks perform the same. Stocks are traded on exchanges and can be bought or sold through brokerage account. Bonds are another popular investment vehicle. When you invest in bonds, you're essentially lending money to a government, municipality, or corporation. In return, you receive regular interest payments and the return of your principal at maturity. Bonds are generally considered less risky than stocks, making them attractive for conservative investors. However, they typically offer lower returns. Bonds can help balance a portfolio and provide steady income, especially during market downturn. Mutual funds allow investors to pool their money together to invest in a diversified portfolio of stocks, bonds, or other assets. Managed by professional fund managers, mutual funds offer diversification and professional oversight, making them a popular choice for beginners. They can be actively or passively managed, and investors buy shares in the fund rather than individual securities. Mutual funds are a convenient way to access a broad range of investments without needing to pick each one yourself. Exchange-traded funds, or ETFs, are similar to mutual funds but trade on stock exchanges like individual stocks. ETFs offer diversification, low fees, and flexibility, making them increasingly popular among investors. You can buy or sell ETFs throughout the trading day, and they often track specific indexes or sectors. ETFs are a great way to gain exposure to a wide range of assets with just one investment, and they're suitable for both beginners and experienced investors. Real estate is a tangible investment vehicle that involves purchasing property, such as residential homes, commercial buildings, or land. Real estate can generate income through rent and appreciate in value over time. It's often used to diversify portfolios and hedge against inflation. While real estate requires more capital and management, it can offer stable returns and tax benefits. Investors can also access real estate through real estate investment trusts, REITs, which pool money to invest in property portfolios. Commodities include physical goods like gold, oil, and agricultural products. Investing in commodities can help diversify your portfolio and protect against inflation. Prices can be volatile, influenced by supply and demand, geopolitical events, and market speculation. Commodities are often traded through futures contracts or ETFs that track commodity prices. While they can offer high returns, they also come with unique risks, so it's important to understand the market before investing. Certificates of deposit, or CDs, are low-risk investment vehicles offered by banks. When you purchase a CD, you agree to lock your money for a set period in exchange for a fixed interest rate. CDs are insured by the government up to certain limits, making them very safe. However, they usually offer lower returns compared to other investments. CDs are best for conservative investors who want to preserve capital and earn predictable interest. Savings accounts are one of the simplest investment vehicles. Offered by banks and credit unions, they provide a safe place to store your money while earning a small amount of interest. Savings accounts are highly liquid, meaning you can access your funds easily. While the returns are modest, they're ideal for emergency funds or short-term savings goals. For long-term growth, you may want to consider other investment vehicles with higher potential return. Money market funds are mutual funds that invest in short-term, high-quality debt securities. They aim to provide stability and liquidity, making them a popular choice for conservative investors. Money market funds typically offer higher returns than savings accounts but lower than stocks or bonds. They're often used for parking cash temporarily or managing short-term needs. While not risk-free, they're considered one of the safer investment options. Index funds are mutual funds or ETFs designed to track the performance of a specific market index, like the S&P 500. They offer broad market exposure, low fees, and passive management. Index funds are ideal for investors who want to match market returns without picking individual stocks. Over time, they've proven to be a reliable way to build wealth, especially for those who prefer a hands-off approach to investing. Retirement accounts like IRAs and 401(k)s are specialized investment vehicles designed to help you save for retirement. These accounts offer tax advantages such as tax-deferred growth or tax-free withdrawals depending on the type. Contributions are often invested in a mix of stocks, bonds, and funds. Starting early and contributing regularly can help you build a substantial nest egg for your future. It's important to understand the rules and benefits of each account type. Annuities are contracts with insurance companies that provide a stream of income, often for retirement. You pay a lump sum or make periodic payments and in return receive regular payouts in the future. Annuities can offer guaranteed income and help manage longevity risk. However, they can be complex and may come with fees and restrictions. It's important to understand the terms before investing in annuities. Hedge funds are private investment vehicles that use a range of strategies to generate returns, including leverage, derivatives, and short selling. They're typically open to accredited investors and require high minimum investments. Hedge funds aim for absolute returns regardless of market conditions, but they come with higher risks and fees. Due to their complexity, they're best suited for experienced investors seeking diversification beyond traditional assets. Private equity involves investing directly in private companies or buyouts, rather than publicly traded stocks. These investments can offer high returns but are illiquid and often require long holding periods. Private equity funds typically pool money from institutional and accredited investors to acquire, improve, and eventually sell companies for a profit. While the potential rewards are significant, so are the risks and barriers to entry. Venture capital is a type of private equity focused on investing in early-stage startups with high growth potential. Venture capitalists provide funding in exchange for equity, hoping that the company will succeed and deliver substantial returns. While the risks are high, successful investments can be extremely rewarding. Venture capital is typically reserved for institutional investors and those with a high risk tolerance. REITs, or real estate investment trusts, are companies that own and operate income-producing real estate. Investors can buy shares of REITs on stock exchanges, gaining exposure to real estate without owning property directly. REITs pay out most of their income as dividends, making them attractive for income-seeking investors. They offer liquidity, diversification, and a way to invest in real estate with less capital. Options are financial contracts that give you the right but not the obligation to buy or sell an asset at a specific price within a certain time frame. Options can be used for speculation, hedging, or generating income. They offer flexibility and leverage but can be complex and risky. Understanding how options work is crucial before adding them to your investment strategy. Futures are standardized contracts to buy or sell assets like commodities or financial instruments at a predetermined price on a future date. Futures are often used by businesses to hedge against price changes or by investors to speculate. They can be highly leveraged and risky, so they're best suited for experienced traders who understand the market dynamics. Cryptocurrencies like Bitcoin and Ethereum are digital assets that use blockchain technology. They offer a new way to invest, with the potential for high returns and significant volatility. Cryptocurrencies are decentralized and not controlled by any government or central bank. While they can diversify a portfolio, they're highly speculative and should be approached with caution. Always research and understand the risks before investing in digital currencies. Collectibles such as art, antiques, coins, and rare items can also serve as investment vehicles. Their value often depends on rarity, demand, and market trends. While collectibles can offer high returns, they're illiquid and can be difficult to value or sell. Investing in collectibles requires expertise and a passion for the items. They're best used as a small part of a diversified portfolio. Peer-to-peer lending platforms connect borrowers with individual investors. By lending money directly to others, investors can earn interest, often at higher rates than traditional savings accounts. However, there's a risk of borrower default, so it's important to diversify across multiple loans. Peer-to-peer lending is a relatively new investment vehicle that offers both opportunities and risks. Robo-advisors are digital platforms that use algorithms to manage your investments automatically. They assess your risk tolerance and goals, then build and rebalance a diversified portfolio for you. Robo-advisors offer low fees and convenience, making investing accessible to more people. They're ideal for those who want a hands-off approach and don't have the time or expertise to manage investments themselves. Target date funds are mutual funds designed for investors planning to retire around a specific year. The fund automatically adjusts its asset allocation, becoming more conservative as the target date approaches. Target date funds offer simplicity and professional management, making them popular in retirement accounts. They're a set-it-and-forget-it option for long-term investors. Unit investment trusts, or UITs, are investment vehicles that buy and hold a fixed portfolio of securities for a set period. Unlike mutual funds, UITs are not actively managed. Investors receive a share of the trust's income and principal as the securities mature. UITs offer transparency and predictability, but they lack flexibility compared to other funds. Structured products are prepackaged investments that combine different financial instruments, such as bonds and derivatives. They're designed to meet specific risk-return objectives and can offer principal protection or enhanced returns. Structured products can be complex and may carry higher risks, so it's important to understand their features before investing. Foreign exchange market, or Forex, is where currencies are traded. Investors can profit from changes in currency values, but Forex trading is highly speculative and volatile. It operates 24 hours a day and requires a good understanding of global economics. Forex is best suited for experienced investors who can manage the risks involved. Investing in precious metals like gold, silver, and platinum is a way to diversify and hedge against economic uncertainty. These assets can be bought directly or through funds and ETFs. Precious metals often retain value during market downturns, but prices can fluctuate based on global demand and supply. They're a traditional store of value and can complement other investments in your portfolio. Government bonds are debt securities issued by national governments. They're considered one of the safest investment vehicles, especially those from stable countries. Government bonds pay regular interest and return your principal at maturity. They're ideal for conservative investors seeking steady income and capital preservation. However, returns are typically lower than riskier investments. Municipal bonds are issued by local governments or municipalities to fund public projects. They offer tax advantages, as interest is often exempt from federal and sometimes state taxes. Municipal bonds are generally safe, but their returns are lower compared to corporate bonds or stocks. They're a good choice for investors seeking tax-free income and lower risk. Corporate bonds are issued by companies to raise capital. They typically offer higher yields than government bonds but come with more risk. Investors receive regular interest payments and the return of principal at maturity. Corporate bonds can be a good way to earn income, but it's important to assess the financial health of the issuing company before investing. Preferred stocks are a hybrid investment vehicle combining features of both stocks and bonds. They pay fixed dividends and have priority over common stocks for payouts. Preferred stocks are less volatile than common stocks but offer less potential for price appreciation. They're suitable for investors seeking steady income with moderate risk. Convertible securities are bonds or preferred stocks that can be converted into common shares of the issuing company. They offer the potential for fixed income and capital appreciation. Convertible securities can be attractive for investors who want to participate in a company's growth while enjoying some downside protection. However, they can be complex and may not suit all investors. International investments involve putting money into foreign stocks, bonds, or funds. They offer diversification and exposure to global growth, but also come with currency and geopolitical risks. International investments can be accessed through mutual funds, ETFs, or direct purchases. They're a way to broaden your portfolio and tap into opportunities outside your home country. Sustainable or socially responsible investments focus on companies and funds that meet environmental, social, and governance (ESG) criteria. These investments aim to generate positive returns while supporting ethical practices. Sustainable investing is growing in popularity as more investors seek to align their portfolios with their values. It's important to research ESG ratings and understand the impact of your investment. Education savings accounts, such as 529 plans, are investment vehicles designed to help families save for education expenses. Contributions grow tax-free when used for qualified expenses. These accounts can be invested in a variety of assets, including mutual funds and ETFs. They're a smart way to plan for future education costs and take advantage of tax benefits. Health savings accounts, or HSAs, are tax-advantaged accounts for medical expenses. Contributions are tax-deductible, grow tax-free, and withdrawals for qualified expenses are also tax-free. HSAs can be invested in stocks, bonds, or mutual funds, offering growth potential alongside healthcare savings. They're a valuable tool for managing healthcare costs and building long-term savings. Crowdfunding platforms allow individuals to invest in startups, real estate, or projects by pooling money with other investors. These platforms make it easier to access alternative investments, but they come with higher risks and less liquidity. Crowdfunding can be a way to support innovative ideas and potentially earn high returns, but due diligence is essential. Direct investments involve putting money directly into a business, property, or project, rather than through a fund or intermediary. This approach can offer more control and potentially higher returns, but it also requires more involvement and carries higher risks. Direct investments are best for those with expertise in the area and a willingness to actively manage their assets. Some life insurance policies, such as whole life or universal life, have an investment component that builds cash value over time. These policies can provide lifelong coverage and a savings element, but they often come with higher fees and complexity. Life insurance as an investment is best considered as part of a broader financial plan, rather than a primary investment vehicle. Savings bonds are government-issued securities designed for individual investors. They're low risk and offer modest returns, making them suitable for conservative savers. Savings bonds can be purchased in small amounts and held until maturity, providing a safe way to preserve capital and earn interest over time. Business development companies, or BDCs, are publicly traded firms that invest in small and mid-sized businesses. BDCs offer high dividend yields and access to private company investments. They're traded on stock exchanges, providing liquidity, but can be volatile and sensitive to economic conditions. BDCs are a way to diversify and seek income from non-traditional sources. Master Limited Partnerships, or MLPs, are investment vehicles that combine the tax benefits of a partnership with the liquidity of publicly traded securities. MLPs are often found in the energy sector and pay out most of their income to investors. They can offer high yields but may be complex and sensitive to commodity prices. MLPs are best for investors seeking income and willing to understand the risks. We've covered a wide range of investment vehicles, each with its own features, risks, and benefits. The right choice depends on your financial goals, risk tolerance, and investment horizon. Diversification is key. Combining different vehicles can help manage risk and maximize returns. Take time to research, consult with professionals if needed, and build a portfolio that aligns with your needs. Remember, investing is a journey, and the best vehicle is the one that helps you reach your destination.